Again, managerial accounting, chapter 5. Now we're going to start running company. In order to run the company, what we need to do, we need to sell a product. Before we sell the product, what we need to find out? We have to find how we're going to produce the core product. Once we produce the product, how it's going to cost, how much it's going to cost us. And once we get the cost, then we can see how much we're going to sell it. With the sales, so what's the idea with the sales? We need to generate enough sales to cover our cost. Which cost? Obviously, that will be depends on the way the costs are. We classify the cost. If we classify the behavior, we need to cover the variable and the fixed cost. If we classify them based on the product and period cost, or the product and period cost. So at the end of the day, sales have to be more than the cost. What classification we're going to choose for the cost, that's irrelevant. We just have to cover all the costs. Now, in order to understand the cost and make the management decisions, we can divide it into different categories for different purposes. Based how the cost behave, we saw last time, based on the cost behavior, we divided on the variable and the fixed cost. Now, today, we're going to go back to the original classification of the cost, which was product cost versus period cost. Product costs, we already know the product cost of direct material, direct labor, manufacturing overhead, where the period cost is anything else, which helps us to run the business. So when we start producing the product and selling that product, we have to cover the cost of the product first. Second, all the business-related expenses, which are for the period. Now, having that in mind, how are we going to get the cost of the product? Well, that will depend strongly on, obviously, we are a manufacturing company. So since we start producing a product, we have to be a manufacturing company. Remember, the businesses or the options for the business that we have, we can easily be in service, we can be in merchandising, or we can be in manufacturing. Now, if you're in the service, we're just selling the service. Yes, there will be some materials that we might have to sell, but at the end of the day, we're just selling the service. If we're in the merchandising business, that's easy. We're buying inventory, selling inventory, buying inventory, selling inventory, buying inventory, selling inventory, nothing else. We're just cashing on the 5% increase of the price and keep going. You have so many examples of this. That's why when the producer produces tomato for 50 cents, then the tomato is sold in the store for $3.99. Why? Because there's so many people which are in that merchandising business, which one selling to another. Now the wholesaler buy from the producer, then the wholesaler sell to another wholesaler, the other wholesaler selling to the merchandiser, not the wholesaler, what would be that? The company that can sell to the individuals, and now you're buying from the store. And you wonder, why I'm paying so much for this product? Well, because there's so many players on the chain. Now, obviously, with the technology and everything, we try to eliminate the players, so we cut the chain and connect the producer directly with the buyer. But that's probably is going to take time. So now the other option that we have here, we to produce the product. So we are now in production site. So in order to produce our product, we can run different costing systems based on the process that we're running in our company. We have two main processes. One is the process costing. The other one is the job order costing. Now we're going to go to chapter 6. Chapter 6 is about process costing. Process costing means the company produces one single product. That's it. The other thing is one product cannot be distinguished from the other product. So because we have those identical products which have the same characteristics, the same quality, the same quantity, the same price, what will be the cost? Well, obviously, the cost will be the same. The question is how we're going to get the cost. Very simple. We're going to calculate the total cost for the period. We're going to divide it by the number of units which were produced for that period, and we're going to get the cost per product. Simple. That's why it's process costing. Which company can use process costing? Everything that producing a single product, like a cement mix. This company producing cement mix, so the whole the cement which is produced within the month, we're going to see the quantity, we're going to calculate the cost divided by the quantity, give it the price per product, or for 1 kilogram, for 1 pound, whatever dimension you're using for selling it, and end of the story. Petrocana, the same thing when they're refining the oil. Coca-Cola, same thing. What are they going to do? We start producing Coca-Cola, producing Coca-Cola, 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 Coca-Cola. When we get sick of the Coca-Cola, we start producing Fanta. Fanta, 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 Fanta. When we start producing get sick of the Fanta, we're going to switch to the Sprite. And we're going to produce Sprite. When we get sick of the Sprite, we're going to produce tonic. And then we're back to Coca-Cola. So for that reason, when you go to the store and you want to buy 2 liters Coca-Cola, are you going for a particular bottle, or are you just grabbing one bottle from the shelf and end of the store? Or you're looking which one is the more full than any other? Means that the distance between the cup and the drink is the less. Well, that's not exactly guaranteed that you're going to get more Coca-Cola, because if the bottle is squished on the bottom, obviously it's going to show more that feel like there's some more liquid. But at the same time, it's probably will be the same. Most likely will be run by the artificial intelligence by now, and that artificial intelligence is going to put exactly the same amount. That's what the process costing. Now let's see what's the other type of costing that we may have, or the other type of company. So both companies going to be manufacturing company, but the difference between one and the other is one will producing the single product, where the other company is going to produce many different products. Example will be, I'm going to give you example right away. Imagine this, I'm a bakery, and in my bakery, I'm focused on producing cheesecake. One option that they have is to get this ginormous amount of key cheesecake mix and all the recipe and start producing cheesecakes for the mass production, for the mass selling. So I'm making a contract with Costco. Costco, the cheesecake last week was on sale. Very good cheesecake, I have to tell you and admit. I eat probably 1.5 pieces. Because usually when I buy something like this, by the time I go home, there's pretty much nothing left. But that's another story. So for the cheesecake, I can produce that cheesecake for the Costco. For Costco, I have contract with the Costco. So what I'm doing is I'm just producing cheesecake. One cannot be distinguished from the other. And what I'm doing is then I put it in the Costco, and they looking for the customers. That will be one option. The other option is I'm producing cheesecake now, but my cheesecake is super special. It's not like a cheesecake on a Costco. It's a very personal cheesecake, which has different mixtures, different flavors. And when you're chopping one piece, there's a pop-up pictures coming and something like that. It's something fancy, customized. And on the other piece, you have marshmallows and all the different things. Now, that cheesecake, I'm producing it only and only when the customer comes and order that cheesecake. So now, what's the interesting part is now I'm not in the mass production anymore. I'm on the producing a single product, and that single product is unique. And one cheesecake is not the same like the other cheesecake. One can be with 2 layers. The other one, I can make it 2 layers cheesecake. How I'm going to make a cheesecake 2 layers is kind of tricky, because the cheesecake mixture is very soft. So how I'm going to exactly do the second layer, that's kind of throw me off a little bit, but probably I'm going to find a way to do it. Anyway, the point is every cheesecake will be unique. The other thing is I'm not start producing that cheesecake until the customer comes and order it. Because of the unique nature of every cheesecake, so what they have to do is come up with the cost for every single cheesecake. So one cheesecake is not going to be the same cost like the other one, and they can be easily distinguished. Why? Because one is with the raspberry, the other one is with the blueberry, the third one is with the strawberry, the third one with kale. You believe it or not, I can make a cheesecake with kale or cheesecake with spinach. Or the one that I like the most is when you here when you go cake. What kind of cake you have? You have a carrot cake. Okay, sounds like I'm a Bugs Bunny and like carrots, so I want carrot cake, which I don't like, but you have to get it right. So, but anyway, the point is that all the different products have their uniqueness. They're super unique, and because of that, the price is different. So example will be Bombardier. Bombardier, they don't make aircrafts anymore. At least, actually, they still doing. The Canada, I believe they sold the brand from aircraft to some US company, but Bombardier still exists. They're producing now the trains, or can be this large-scale construction company, which for every construction, every building, and every road and every bridge that they have to bring built, that's unique. So because of the uniqueness, we have to come up with that specific cost for that specific project. Hallmark is the greeting card. That will be another example. Now the question is, in summary, when we have a process, the number of the jobs that we work, we're producing only one single product. The cost, how we're going to come up with the cost, we're going to accumulate the cost by department. And cost per product will be average cost, which is computed based on the department divided by the number of the products. In the job order costing, when we're using the job order, we're going to have different jobs, so many jobs. Oh, but the cost will be accumulated only by the job, and the average cost will be computed only by that particular job. Nothing else, nothing more, nothing less. Which brings us to this question. Which of the following companies most likely will use the job order costing rather than the process costing? So in other words, which company producing single product, which comes with the request by the customer, and which company producing product and just looking for customers to buy it. First one is the Scott Paper Company for Kleenex. What kind of job costing will be that? Process or job costing? What do you think? Process costing, no questions about it. How about this architects? Job order, correct. The customer comes and say, I want to build two-bedroom house. The other one comes, I want to build a two-bedroom house, but I want to have a den. Plus, I want to have a basement, right? How about hands for ketchup? Process, obviously. Caterer for wedding reception. Wedding, that will be job order. How about the builder of commercial fishing vessels? Think about it. Commercial fishing vessels. Can I start building commercial fishing vessels and this month or within the year to build like a 50,000? Is that possible? Or it has to be very specific, right? It's obvious it's going to be job costing. That's why we're going to use the job costing for that vessels. Yes, only the Scott Paper Company and hence will be on the process. Everything else will be job costing. All right, so now let's start getting the cost. How are we going to get the cost? In order to get the cost, we need three things for our product. We need three costs. We need direct material, within direct labor, and we need, what's the third one? What's the third element of the process costing? To produce the product cost. One is direct material, the other is direct labor, third one is overhead. Yes, manufacturing overhead. Absolutely correct. So now, at this point, usually I'm stopping with the slides and moving to Excel spreadsheet. Why Excel spreadsheet? Because I find it a little bit more interesting and easy to explain this concept about the process job costing on the Excel spreadsheet. So in order to do that, of course, I have to share my screen with you. Otherwise, we won't be able to see my Excel spreadsheet. So there you go. That's my Excel spreadsheet. If we go back to chapter 2, and remember when we calculating the cost of goods sold. That's what we're chasing again. We're chasing cost of goods sold. That's what we want to find out. The question is, how are we going to produce our product? First, obviously, we have to get some inventory accounts. Since we're in the manufacturing company, we're going to have exactly 3 inventory accounts, which will be those like raw materials, definitely. Then we're going to have work in process. Then we're going to have finished goods. We're going to start again raw material. And then we're going to extend to the work in process and finished goods. What's interesting with those accounts? They are all asset accounts, all part of the inventory. They all, since they're asset account, their normal balance is always debit. What else is interesting? They have a beginning balance and have an ending balance. Let's make the first one, and then I'm going to start copy and paste beginning balance, and they're going to have the ending balance. So that's my raw material account. So now I need 3 more these accounts. So I'm going to copy this one. I'm going to flip it right here. I need some space, and I'm going to flip right here, which will be my finished goods. And after that, I have my income statement. On my income statement, I'm chasing the revenue, and I'm chasing my cost of goods sold. After that, I'm going to calculate the gross margin, because this will be the traditional income statement, gross margin. Then I'm going to have the operating expenses, and the last one will be operating income. And that's where I am. That's what I need. I need to get operating income more than 0. So I have to make sure that my revenue covers the cost of goods sold and operating expenses. Otherwise, I'm in trouble. So the inventory accounts, raw material is the first one. Second one is the work in process. It's not rest in peace. It's work in process. And the last one is the finished goods. The cost of goods sold, we already established, this is going to come from the finished goods account. No questions about it. This the finished goods account will be the one that's going to trigger the cost of goods sold. So that's why we have to accumulate those costs there in order to have calculation for cost of goods sold. Let me insert one shape here, which I'm going to use repeatedly, probably, to get the cost of goods sold, which is right here. I need to get this number, which is going to come from the finished goods. Now let's start with the normal process. In order to have the product, I need 3 costs. So I need to add one more line here, just to keep it even. So I need to have direct material, I need to have direct labor, and I need to have manufacturing overheads. If I don't have those 3, I won't have a product. If I don't have a product, I'm not going to have finished goods. If I don't have a finished goods, there's nothing for me to sell. So I need to produce this product. In order to produce it, I have to have all those three elements. Let's start going with the direct material. Direct material is the first one. From where I'm going to get the direct material? Obviously, direct material is going to come from the raw material. Once I use the material, that will be material used. Once I use my material, one option that I have for those material is to be direct. So what I'm going to do, I'm simply is going to get this arrow. I told you that I'm going to use this repeatedly. And that's where my direct material comes. Directly from the material used. I cannot use the material if I don't have the materials. So it's very imperative for me to purchase the material. So that's where the thing starts. First, we're going to purchase the material. Then we're going to use the material. I have the direct material. As we already know from the how we applying the cost to the product, we have direct cost and we have the indirect cost. Obviously, I'm going to have some indirect material. Direct material will be the one I can easily trace to the object or to the product, or my object here will be the finished goods. And there will be costs which I cannot easily trace to the object or for the finished goods, and that will be my manufacturing overhead. So for that reason, what I'm going to do, I'm going to open a new account, which will be right here, and it's going to be called manufacturing overhead, directly manufacturing overhead account. What I'm going to do with this manufacturing overhead account, I'm going to start accumulating how much cost I'm spending for the manufacturing overheads. And I'm going to open it right here. Now, what's the interesting with this account? This account is not a balance sheet account. This account is not asset account, it's not a liability account, it's not income statement account, it's not asset account, it's not balance sheet account. That doesn't belong anywhere. But you still have debit and still have credit. And I'm going to use it only and only for the time being during the period for cumulative purposes. I want to get some calculation from this account. What will be the calculation? I want to calculate how much I'm going to spend for the manufacturing overhead. So every time when I use cost for the manufacturing overhead, I'm going to apply to this account. So on the debit side, I'm always going to apply the actual cost, which actually I'm actually using. So we use the material. We get the direct material. What we're going to do with the indirect material, we're going to apply directly to the manufacturing overhead account. And that will be our indirect material. So what will be that? Now I have to get a new shape, which will be from the shapes, it's going to look like this. So I get my material. Now let's go to our indirect material, which will become right here. So I have to extend it. You know, this always give me this trouble, this line. For some reason, it's flipping one side to another side. Maybe I should extend it this way and then try to apply it. Extend it this. It still doesn't work because I want to increase it. Oh, I think I got it this time. That's the first. Okay, that will be my indirect material that I'm going to use. I don't want it this way. Still want it this way. Let me see if I can make it. Yes. And this will be my indirect material. So I have my direct material, I have my indirect material. From where they're coming? They're all coming from the material that I'm using, which coming from the raw material account and which coming from the purchases that I made. Okay, so I have the first element, which is direct material. And I have the second element, which is the indirect material related to the indirect material. I'm going to move those one a little bit here because we're going to plug later some numbers so we can use all this chart a little bit more interactively later. And indirect material is going to go right here, indirect material. Now let's make it red. So the first piece, we have it. Second piece that we're looking for is direct labor. Now, direct labor is going to come from account, which we all know that's a payroll account. Now, for those accounts, I'm not going to be so hangout. And I'm just going to make some simple here. Account, so now the payroll account, obviously, that will be payroll account, that will be payroll payable account. That will be liability account, but anyway, from the credit side, I'm going to get my direct labor. Let's get this shape here and get the direct labor. From here, it's going to go right here, direct labor. And here you go, I have my direct labor now. Which comes directly from the payroll payable. Let's mark it with this one will be in the dark blue color. Also from the same account, we're going to get the indirect labor. Why? Because we're always going to have these people who's going to be related to some cleaning services, some security services, anything that supports our business, and that's going to be related to our indirect labor. So we have that cost as well. So we have from the payroll account, we're going to get the direct labor and indirect labor. We got both. Excellent. What else are we going to have? Now we have to start getting other costs. What will be the other costs? Now we're going to start getting the insurance. We're going to get utilities. We're going to get some rent. We're going to get some, what else? What else we can get? Other material or some other cost. Security. And all the other costs which we need for the business, which are related to directly because we manufacture our product. It's not directly related to the product, but it's part of the operating system, part of the product. We cannot easily trace them, but they're part of the manufacturing overhead. So from where those costs gonna come? They're gonna come from other account, which is also liability account, and those will be other payables. Let's put it here, and those will be accounts payable. All those account payable accounts going to trigger all those different costs that we have to deal with. Insurance, utilities, rents, and other securities. I'm just going to put one line here, and that will be all, or maybe two, just to be obvious. Excellent. So the way I see it, as you can see here from our chart, we can easily get direct labor, direct material, and direct labor. We can easily get indirect material and indirect labor. Then we're going to start accumulating insurance, utility, rent, and other security. Now, the question is, how are we going to get this manufacturing overhead cost? Now, before we get to get the point to get the manufacturing overhead cost, we have to think of what the manufacturing overhead cost represents, when we're going to get the actual bill for those costs, and when we have to pay those bills. Well, let's think about it. Insurance, we have to pay it in the beginning of the period, which is going to cover the entire period. Utilities, you have to pay it later when we use the utilities. Rent, now the rent we usually paying upfront. The other cost, it can be any cost, telephone expenses, can be internet expenses. They usually come for the current month, they come after the period. And sometimes they have costs which are related to the previous period. Sometimes they portion for the prepayment for the period of front. Security usually we may go with the bill which is like 3 months or 6 months, and we paying once, and that's applied for the whole uh, 6 months or long period for that. Okay, great. So far, perfect. But the problem is manufacturing overhead, the actual cost comes on the different period. The question is, where do I need manufacturing overhead cost? Let's think about it. Let's open a coffee shop. What's our product? We're selling coffee. Let's start the business on January 1st. Why? Because nobody works on January 1st. We'll be the only one who working on January 1st. What we're trying to catch? We're trying to catch those people who are celebrate all night, and late in the morning they're going home, but they need that coffee too for so many reasons. So we're gonna open at 6 o'clock on January 1st. Now the first customer comes and he said, "Can I have a coffee?" Obviously, we're a coffee shop. Of course, we're gonna say, "Yes, sir, you can have a coffee." How much? That's the next question. How much for the coffee? And we're doing this math, very simple math. Okay, for the direct material, I can easily estimate it. I need to probably, I know I can easily count how many pieces of coffee I need to grind to get the mixture, which is equal to the one coffee that he wants. That's easy. If he wants latte, I can add the milk and I can calculate the cost. So direct material is not my problem. For the labor, same thing. I can easily estimate that I can, if he wants espresso, it's going to take me 3 minutes to go to the machine. The machine has to warm up and process all the mix and get it to the cup. And then when I get the cup, I have to put it in the bigger cup or mix it with the coffee or make it latte or keep it espresso. I know, and I'm paying myself, you're paying yourself, let's say $35 per hour. You can easily come up with the cost of that 3 minutes that you need to prepare that coffee. That's not your problem. The problem is manufacturing overhead. Why? Because the cost for the electricity is going to come after 2 months. Insurance, you're paying insurance every June. Now you have to pay the property taxes on the place, which you pay again July or June or July. Then you have to pay for the rent, which you pay in December. Then there's security, which security costs comes in February. So it's kind of mess with the cost. So if you want to get the accurate cost, you have to wait for the entire year to pass, then combine the cost and see how much manufacturing overhead cost you actually use. And then you can charge it to your coffee, which you're selling on January 1st. So what are we going to say for the clients? You know what? I can easily calculate direct material. I can easily calculate direct labor. But this manufacturing overhead, this is the thing that drives me crazy. So it's very hard for me to calculate it because the costs come in different periods and I have to wait for the end of the year to make sure that we have exact manufacturing overhead because I have to include it in the cost of my coffee. So you know what? Why don't you take the coffee and come on December 31st when I have all the cost, and then I can tell you how much it cost, and then you can pay me. Is that gonna work? What do you think? And how much coffee are we gonna sell if we go in this direction? Are you guys with me? Can you guys hear me?
Yeah, we can hear you.
So what we gonna do with manufacturing overhead cost? How are we gonna get that cost? Shall we wait for December 31st, or we should charge the client something? And if we charge this client something, how are we gonna come up with this cost? Because we need, obviously, in order to have a product, we need that manufacturing overhead cost. What are we gonna do? Give me some ideas. Give me some suggestions. Estimate it. Excellent. Xiaolin, thank you. We're going to forecast it and estimate it. Exactly. That's exactly what we're going to do. And then once we estimate it, we're going to apply it. Now, the question is how we're going to estimate it and how we're going to forecast it. So we're going to use something which is called manufacturing overhead rate. How are we going to get that rate? That's the key now. Now, what we're going to do is, you see, I have here the actual manufacturing overhead cost. Now, what I'm going to do on the separate calculation, I'm going to get the total manufacturing overhead cost for the period. Now, the question is, what period we can choose? Well, obviously, we're going to choose some big period, which will be the entire year. Once I get the manufacturing overhead cost for the period, then I have to choose something which is common for all my products to allocate all this cost to all my products, which I can call it allocation base. And then I have to estimate. So let's not forget here, estimate it. Let's leave it this way, manufacturing overhead cost, the period. And let's merge those one, and then we're gonna have this beautiful calculation here. We're gonna estimate total manufacturing overhead cost for the period. Now we have to estimate total allocation base for the same period. Let's get our estimated allocation base for the period. Once I have those two, that will be my numerator, that will be my denominator. So I choose the wrong one instead of merging. Now I have both numerator and denominator. What these two gonna give me, they're gonna give me my desired number, which is gonna help me to apply manufacturing overhead, which will be predetermined manufacturing overhead rate. That's how we're going to call it. Predetermined manufacturing overhead. Why is predetermined? Because we calculating it before the start of the period based on, as you can see, based on only on the estimation. Now the question is how accurate we can be. That's a different story. Let's leave it for now. But leave it for later a little bit. For now, I have something that's going to help me to calculate the manufacturing overhead. So since I have estimated my allocation base and calculate my predetermined manufacturing overhead, every time when I actually use allocation base, I can apply manufacturing overhead. So my problem is solved. Magically, I solved my problem. Now I can calculate my manufacturing overhead. Since I can calculate my manufacturing overhead, I can apply my manufacturing overhead. Let's apply it. Let's put this manufacturing overhead where it belongs. So let me grab it and move it from here, right here. And now I have manufacturing overhead. And that will be, let's choose another color. Let's go with purple now. I have my manufacturing overhead, which manufacturing overhead is not actual, it's applied. Now I can calculate my product cost. If I can calculate the product cost, I can calculate my cost of goods manufactured. If I get my cost of goods manufactured, I'm going to move it to the finished goods. Once I move it to the finished goods, then I can calculate my cost of goods sold. And my problem is solved. Now we can start selling coffee, believe it or not. Finally, we can start doing our business. Now, what we have to make sure is this cost is covered by the sales, by our revenue. Plus, we have to keep in mind that we're going to have some administrative expenses. We're going to have some sales expenses, which also has to be covered by the revenue that we're generating from our customers. So, in order to generate operating income, we need to have direct material, direct labor, manufacturing overhead, calculate the cost of goods manufactured, which later is going to become a cost of goods sold. Once we start selling the products. Once we start selling the products, we have to make sure that those cost of goods sold are covered by the revenue. And from the revenue, we need to generate gross margin, which is also going to cover our operating expenses so we can generate operating income. Otherwise, we're never going to be profitable, people. And trust me, not being profitable is not a good thing. At least doesn't give you too much excitement. So what we're going to do now? Where are the options now? Now we are on the manufacturing overhead. At the end of the period, we have to close this account. Because again, it's not a balance sheet account, it's not income statement account, it's just an account, which is using for cumulative purposes. What we accumulate, on one side, we're accumulating the actual cost. On the other side, we're accumulating the cost that we are applying as a manufacturing overhead during the period, which period is 1 year. So here I'm going to have the annual actual cost, and here I'm going to have annual applied manufacturing overhead. So let's see what options we have here. There are not many options. There are like 3 options here. First option, my actual cost is $100,000. I calculate my cost and my actual cost is $100,000. Well, guess what? What I applied is also $100,000. In that case, I don't have to do anything. Why? Because my debit is equal to my credit and life is beautiful. Unfortunately, this situation, the chances this situation to happen are very, very, very minimal. So which are the other possible situations? One possible situation is the actual cost is $120,000. Now I have a problem. Why? Because for some reason, my actual cost went more than what I applied to my product. What that means to me? Means that I'm applying less manufacturing overhead. So since I'm applying manufacturing overhead, my cost of goods manufactured is understated. If the cost of goods manufactured is understated, my cost of goods sold is understated. But that cost of goods sold is going to hit me on the income statement. So let's see, my revenue is 110,000. Now let's make it 120. No, 130. Let's go 130. I like that number. 130 is better. Why you're going to see it later, just in a second. 130. Let's stay with 130. Now, based on my calculation, what I applied during the period, I don't know this number yet because it's not the end of the month, the end of the year yet. I found this at the end of the year, but during the period, I apply cost of goods sold $100,000 based on what I'm allocating. My gross margin in this case is 30,000. My operating expenses are 40,000. No, let's keep it 20,000. Let's make some profit. And my operating income is, at this point, is 10,000. So I'm happy. I'm making my 10,000. It's not perfect, but I'm getting how much is my return here. Let's see, 10,000 divided by 130. I'm getting my 8% return, better than the bank. Bank's going to give me 3% or 2%. I'm getting 8%. I'm okay. Until the year end comes. And then what I'm going to see? Oops. The manufacturing overhead that I apply over the year is under. So my manufacturing overhead is understated. My cost of goods manufactured is understated. Cost of goods sold are understated. My gross margin is now overstated. And my operating income is overstated. What that means to me? That means that in this situation, I have to adjust my cost of goods sold. Why? Because I under applied manufacturing overhead. How much I under applied? I have debit side balance of $20,000, which $20,000 I have to close it on the credit side, which if I close it on the credit side to bring everything in balance, that means I have to increase or debit my cost of goods sold. So let's see if I have to adjust my cost directly, my cost of goods sold, what's going to happen? Those 20,000, they're going to go directly here. So instead of $100,000 on the original scenario, my cost of goods sold now will be the 100,000 plus the 20,000, which is the actual cost. Now my cost of goods sold matching the actual cost, which is 120. And what's happened accidentally? My 8% gone to 8% loss. Oops. How do you like this scenario? Let's see the other scenario. There's another possible scenario. The other possible scenario is, now let's go back to this reality. My possible scenario is now my actual cost is still $100,000, but what I apply is $120,000. So what's happened in this case? In this case, my manufacturing overhead is overapplied, which makes my cost of goods manufactured overstated, which directly transfer to the cost of goods sold, which is overstated again. And what I'm seeing is, oh, I'm losing money. Until the end of the period, and we see that my actual cost is actually $100,000. Now, what we have to do? Now, as you can see, we have on the credit side now debit balance of $20,000. So now I have to credit the cost of goods sold by debiting manufacturing overheads in order to bring them to where they're supposed to be. So that's $20,000 now it's going to affect my cost of goods sold directly. Let's extend it all the way here, talking about those $20,000. So what's going to happen now with my cost of goods sold? I have to reduce it now with the $20,000. If I reduce it, oh, suddenly I'm profitable now. The question is, which one is better for me? Manufacturing overhead to be overstated. In this case, it's over-applied. Let's change it over-applied. Which situation is better for me? To have manufacturing overhead over-applied or to have manufacturing overhead under-applied? Nina says over. Let's think about it. What's going to happen if I over-apply my manufacturing overhead? My cost of goods manufacture is going to go overstated, correct? My cost of goods sold is going to get overstated again. If that happens, I can see I start losing money. How can I overcome losing money? By increasing my sales price, because I don't like to lose money. So I have to push my sales price for my product to generate instead of, because I want my 8%, so I have to increase the prices to generate me $150,000. What's going to happen with my clients if I increase my coffee price? I'm going to lose the clients until I find out that actually I'm wrong and I'm not making I'm making way more than my 7%. I'm making 20% actually. But guess what? I'm not going to make it anyway because my overall sales going to go down. So is the over applied now a good thing? Looks not. Let's see on the other one. How about under apply? On under applied, looks like we're making money. But if we under apply, where that's going to hit us? Opposite. Suddenly, I'm seeing that my product cost is lower. So that may trigger to make me to reduce the sales price to attract more customers. Once I reduce the sales price, what's going to happen? My operating income is going to go down, right? Now let's go with 130. Now 125. Let's reduce our income until at the end of the period, I find out that, oops, that even trigger higher loss. So none of those scenarios looks okay. The best scenario, obviously, we to get the perfect situation, which whatever the actual cost is, will be exactly equal to over apply or onto the applied cost. In that case, my cost of goods sold is going to be $100,000. There will be no adjustments. So whatever I get, that's what I get. Unfortunately, in life, that's pretty much never happened. Now you may ask me what will be the possible tolerance for mistake. I would say anywhere between 2 to 5% mistake on the actual versus applied will be acceptable. Anything higher than that probably is not going to be acceptable. The other thing that I want to tell you is It doesn't matter how good you are on the estimation, because obviously this will be the crucial part of the whole calculation. How are you going to come up with the predetermined manufacturing overhead? If you get the right predetermined manufacturing overhead with the pretty much close to the reality usage of allocation base, you'll be in the right track. Let's pretend that you're very good at this and your mistake is usually less than 2%. Now let's go back to 2020. How many managers do you think predicted and included the effect of coronavirus on the calculation for their predetermined manufacturing overhead rate? Pretty much nobody, right? Who would know that I'm going to start, because when you're doing the predetermined manufacturing overhead, when you're calculating it, you're usually doing it at on the before the start of the period. So you want to start from January 1st with having that predetermined manufacturing overhead available. So you have to be ready by the end of December with that predetermined manufacturing overhead. So you can start the whole year and you not, so the other thing is determining manufacturing overhead is once you calculating it, once you choose it, you're not changing it until the end of the year. So the chances somebody to come up in December that in March, all the businesses will be closed for the customers, the chances are pretty much zero. So it doesn't matter how good you are, you'll never be able to see what exactly is going to happen. I mean, probably even if we had artificial intelligence at that time available to predict the future, even that thing won't be able to predict what's going to happen. So it's a high level of understanding, and it's kind of crucial for the companies. The other thing that I want you to understand is if you are good of inclusions on the actual side, then you're going to be good after estimating the manufacturing overhead cost for the period. Then you're going to be good for the calculation preliminary manufacturing overhead. So what's the objective here? Any costs which are related to the product, you to include it in the manufacturing overhead. That will be transferred to the manufacturing overhead of the product. That will be transferred to the cost of goods sold, and we're going to get the client to pay for it. Because if the client doesn't pay for the cost, the thing is somebody has to pay it. If the client doesn't pay it, you have to pay it from your gross margin. So in that case, make sure that you're making enough gross margin to cover all the costs that you forgot. Because in reality, if we have to be realistic, how many of you ever experienced this? You're going to Best Buy, right? You're going to Best Buy, you're buying a laptop, you're going to the cashier, you pay for it, and you're walking out of the store. And by walking in the mall or the shopping center, whatever you are, suddenly you're hearing somebody running after you. And you see a person of Best Buy. And he tell, I'm so sorry, I'm so sorry. I know you purchased this laptop right now, and I know you pay for it. But you know what? Our manager, he forgot to include the security cost for the entire year in the estimation of the predetermined manufacturing overhead, which affect our sales price. And for that reason, can you come back and there's another $10 that you have to pay so we can cover that cost for the security, which otherwise we're going to lose money. Anyone ever have that experience? And what's going to happen if this actually happened to you? Would you pay $10? Right? Why would you pay? If you include it, include it. If you forgot to include it, I'm sorry, your loss is your loss. Why your loss has to be my loss too? So you understand how uh, important is manufacturing overhead? Because again, I want you to understand this. If you don't transfer the cost to the client and make the client pay for it, you have to pay. From where? From your gross margin, which automatically is going to reduce your operating income. So for that reason, what that means, let's pretend I'm on Douglas College. What I'm going to include in my manufacturing overhead, everything possible. I'm going to transfer the cost to my client. So if I'm planning to run events, which event is for the students, which happen to provide a free popcorn, where the cost of that event is going to be? In the manufacturing overhead. So for that reason, next time, when you see a free popcorn, go and get it because it's not free. Most likely you already pay for it. Which brings us to the other main point, which is every time when you see something for free, think about it. Nothing is free. If it may look for free, it's definitely part of the overhead. Food sampling in the store looks like a free food. Absolutely not. Where is it? On the markup on the store. So when you see the free sampling, go and get some because you already pay for it. Or you're gonna pay when you purchase the next item. Why? Because it's included in the manufacturing overhead. And that's what the good estimator is doing. They're trying to capture all the cost, which is related to the product and to the product process, included as an indirect cost as a manufacturing overhead, and transfer the cost to the customer. Otherwise, somebody has to pay for it. And usually will be the shareholders from as part of the operating income. That's your job costing. That's how you're pricing the product. That's how you get generating gross margin. That's how you're generating operating income. Now, what we have to do is we have to repeat everything through the slides. Now, let's go with the slides. Remember where we left the slides? We left the slides here on the direct material and manufacturing and direct material, direct labor. Those are the direct cost, which is directly easily traced to the job, which was purchased by the customer. Now, the problem is manufacturing overhead. In manufacturing overhead, again, we have indirect material, indirect labor, and so many other indirect costs, which are directly related to our product, which has to be part of the product. So let's go with this job cost sheet. With job cost sheet is going to give us an idea how much material we're going to charge to this job, how much labor we're going to charge, how much manufacturing overhead we're going to have, and what will be the total cost for this particular job, and how much will be the unit cost based on this job costing sheet. First, material, we're going to go to the inventory available. We're going to pick up the material. We know exactly what we pick up. The cost for the material, it's easy to calculate. We get the material. Material cost us $116. Why? Because with this using this material, the cost for the material $160. The material done. Labor. We're gonna get this student probably to work for us. I know the rate is not appropriate, $11, having in mind that the minimum wage is going to jump to $18 or $17 Actually, it's already there because it's June 1st. After June 1st, the minimum wage in BC went up, correct? Let's see what's the minimum wage starting on June 1st. Went to 18.25, effective Monday. As of Monday, the new minimum wage in BC is $18.25. So this one paying $11, that's probably not appropriate, but that's example here. So we're calculating the $88 direct labor, and we're moving on with this calculation. We get the direct labor. Now manufacturing overhead. Manufacturing overhead. In order to allocate manufacturing overhead, we have to choose allocation base. What we're going to choose for allocation base? Most likely, still, we need those direct labor hours from our workers. So direct labor hours most likely will be the proper allocation base. If not, maybe we can go with machine hours or artificial intelligence hours. Let's make something new twist in the job costing. Now we're going to start calculating how much artificial intelligence actually spent on this job. And we're going to start allocating the cost of the artificial intelligence. How that sounds? That sounds like a fairy tale, isn't it? But anyway, why we need to use allocation base? Because otherwise it will be impossible or very difficult to allocate manufacturing overhead. We need that manufacturing overhead, otherwise we're not going to have the product cost. Manufacturing overhead, again, consists so many different items and so different costs, which are coming on from different stages, different places, and different time. Many types of manufacturing overhead are fixed, which output actually usually fluctuate during the period, and the timing of the payment of that cost is different. So having this in mind, what we're going to do, we're going to come up with this predetermined manufacturer overhead rate. How are we going to get it? First, we're going to estimate total manufacturer overhead cost for the period that's coming. How are we going to get it? One option is to get the previous period, adjust the cost. We already, since the most of the costs are already fixed cost, we might be able to find what kind of contract we sign for the next year. What is the total fixed cost? What's the fixed cost for the rent? What's the fixed cost for other items that we may already have a contract, and calculate that cost. If this is the first year of operation, then what you're going to do? Well, there's Statistic Canada, and you can check the similar businesses with the similar size and the similar industry, what kind of cost they have. That will be one option. The other option is, again, try to do your best to come up with the cost. Some of the costs are already fixed, so you should be able to easily get those costs. Once you do that, your job is not done. Now you have to get, once you get the allocation base, you have to come up with the usage of allocation base. And if the direct labor hours are your allocation base, you can easily get the numbers, knowing that one full-time employee working for you 7.5 hours, that employee is going to give you 1,950 hours per year. If that particular employee work 8 hours, then that employee is going to give you 2,080 hours per year. And this is the capacity that you have. Ideally, that allocation base has to drive the overhead. Once we come up with this, why do we need this predetermined overhead? Again, using predetermined make it possible to estimate the job cost because we're going to have the third element of our product cost, which is manufacturing overhead. Actual overhead for the period is not known until the end of the period. That's why we need this predetermined overhead rate to estimate and start applying manufacturing overhead from January 1st. Predetermined rate is based again on the estimation, not on the actual, but predetermined overhead, once it's computed, it doesn't change during the entire period. So it stays the same all the time. So again, once we get the predetermined overhead rate, we're going to apply it by using the actual activity of allocation base. And that's how we're going to get it. So let's say this company, they calculated the total cost will be $640,000 for the period, coming period. And their allocation, total allocation, usage of allocation base will be 160,000 hours, direct labor hours. So that makes it predetermined overhead of $4 per direct labor hour. Once we have that one, now we can start applying manufacturing overhead. We already know that our worker work 4 hours, 8 hours. And since we're applying $4, that will be another $32 manufacturing overhead. Now I have the total cost. Once I check how many units I completed, and I see I completed 2 units, then I can come up with the unit product cost, which is $180. Now, average unit cost should not be interpreted as actual to be incurred if one additional unit. So the question is, if I make 3 units, if the customer says, okay, 2 units, how much is the cost per unit? 180. Can I have another one? Well, yes, you can, but the cost for the one additional one, it might not be 180. We have to run a new calculation and see how that cost is going to be. Why? Because the fixed overhead would not be charged if one unit is produced or another unit is produced. So for that reason, we have to be careful if the client comes and say, hey, can I have one additional unit? Choice of the allocation base for the predetermined overhead rate will be usually something that drives the cost. Because if we choose the allocation base that doesn't drive the cost, then we may have a product which don't have manufacturing overhead rate. That's gonna deteriorate the cost of our products and gonna give us a problem of the calculation of the operating income. That's why the common allocation base is direct labor. And now we can start with our simple calculation, one after another. So let's start with this. This company required 200 of direct labor. This job provided with this company required 200 of direct material and $10 direct labor hours at $15 per hour. Estimated total overhead for the year is 760 and estimated direct labor hours are 20,000. What will be the recorded total cost for this job? And we have 3 options, 200, 350, 380. Before we start with the calculation, I want you to think first. How much is direct material? 200. Is it clear for everybody that direct material is $200? How much is the direct labor? 150. Now we have 2 costs, direct material and direct labor, correct? Is it possible my total cost, which include direct material, direct labor, manufacturing overhead, to be $200? Is it possible to be $200? Is answer A possible solution? No. Is answer B possible? No. Why? Because including only direct material, direct labor. Now, what are the chances manufacturing overhead to be only $30? Is that possible? $30 to be manufacturing overhead when you have 760 divided by 20, or you have 76 divided by 2. Is it possible to be $30? No. So what will be the possible, most likely correct answer? Do you have to calculate? That's my question here. Do I have to spend time to get the calculator start calculating? To come up with the logical answer? That's what my question is. Not really. Well, why don't you use this logic when you're answering the multiple choice questions? Or rather than just jumping on the numbers and start calculating, just use your logic. Eliminate the incorrect answers and come up magically, you're going to come up with the right answer. That's how it should be done. Do you understand this? I want to show you a new way to solve the multiple choice questions if it's possible. You to use your logic. Now you have enough knowledge. So let's see the how the everything is calculated. Obviously, predetermined manufacturing overhead will be 76 divided by 2. Once we eliminate the zero, $38. Half of the 76 is 38. But we need the direct labor hours because we are applying it. Our allocation basis direct labor hours. So we have to time it times 10, and that's going to give us 380. So the answer C is actually the cost of the manufacturing overhead. And then we have the 250, 380. Logical answer is 730. Now let's see the flow of the documentation that we need to get this job done. First, remember, this is the beauty of the job costing. You not start production before the client call you and order the product. Once the client call and order the product, then you're going to start production, which is perfect because you already have the sales guarantee. Once you start the production, what do you need to do? You need the material, you need the labor, and you need the manufacturing overhead. Manufacturing overhead, you're going to get it when you have the display terminal rate. Once you have all those, you're going to put everything on the job costing sheet. From the job costing sheet, you're going to calculate the cost, total, and per unit. The flow of the cost is right here. Now we can put it through the T accounts. The way we put it on the graph that I show you. Now we're going to put it in with debit and credit. First one, direct material. What we're going to do with direct material? Direct material is going to come with the raw material. But first, we're going to have to purchase the raw material. Once we purchase the raw material, then we're going to use it as a direct material. And then we're going to use it as an indirect material. Direct material, we're going to apply directly to the work in process account, where the indirect material we're going to apply to the manufacturing overhead account, which will be our cumulative account for the period in order to calculate manufacturing overhead. Again, first one is to purchase the raw material, debit raw material, credits accounts payable. And second one to assign the direct material debit working process, assign the manufacturer overhead, debit manufacturer overhead, and we're going to take everything from the raw material inventory account as a credit. Once we're done with direct material, we have to deal with the direct labor. Direct labor is going to come with the salary or wages payable, whatever account you're running, or whatever your employee you have. That will be direct labor. But you're also going to have the indirect labor, which the indirect labor is going to come from all the other costs for the labor that you may have. So how are we going to apply this? working process for direct labor, manufacturing overhead for the indirect labor, and everything is going to come from the payroll or salary payable account. Then we're going to start dealing with the other manufacturing overhead. What will be the other manufacturing overhead? There will be so many options. We may have accounts payable, we can have property tax payable, we may have prepaid insurance, we may have accumulated depreciation, all those different costs. Once we're done with this, we're going to start applying the overhead. How are we going to apply the overhead? By using the predetermined overhead rate. So we're going to debit the work in process and we're going to credit the manufacturing overhead by applying the overhead. Once we're done with that, the overhead account, we're going to do the final calculation at the end of the period. We're going to calculate the actual cost and we're going to compare it with the applied overhead. Once we do that, we're going to either find the over-applied or under-applied, but that's going to happen at the end of the period. Before that, let's do the some thinking of what we're going to do with the period cost. Period costs, those will be directly expensed. They go directly to operating expenses. What will be that? That will be marketing, selling, accounting, advertising expenses, anything that help us to sell our product. And then we're going to have this salary expenses, salary payable, advertising expenses payable for the different money, marketing or administration cost. The last thing that left is to sell the product. Once we sell the product, we have to account for the cost of goods sold. Now we're selling our product. We're going to have, actually, no. First, we have to move the finished goods. Once we finish the direct material, direct labor manufacture overhead, then we're going to have cost of goods manufacture, which cost of goods manufacturing has to be moved to the finished goods. We're going to debit the finished goods and we're going to get credit the cost of goods manufactured. And that's going to help us to move the product that we produce into the finished goods ready to available for sale. Once we sell them, they become a cost of goods sold. Before they become a cost of goods sold, we have to show first the sales, which we're gonna debit accounts receivables or cash, and then we're gonna have the cost of goods sold, and we're gonna reduce the inventory for the cost of goods sold. At the end of the period, we're gonna go back to our overhead account. And we're going to start looking what's happened with that account, what kind of balance we have. Options are we're going to have under-applied overhead. The other one is over-applied. We're going to have under-applied overheads when the amount of the overhead applied to the job during the period is less than the total actual amount. Then we can have under-applied. Over-applied is when we're applying the overhead during the period. At the end of the period, we find out that amount that we applied as overhead is more than the actual cost. And that brings us to the point, what we're going to do. First, let's do this simple question here and see what's happened with this company. The actual overhead was 650,000 with the total of 170,000 direct labor hours. How much total overhead was applied during the year? This company predetermined overhead was $4. So how much is the applied overhead? 680. How much is the actual? 650. So what we have, over-applied or under-applied? $30,000 over-applied. Okay, great. So in this case, we have over-applied overhead of $30,000. Now the question is, what we're gonna do? First option is to allocate it directly to the cost of goods sold, the way I show you. The second option is to allocate it to all three accounts: work in process, finished goods, and cost of goods sold. Why? Because the chances we to have products in all those accounts is high. So let's see. Option one, directly move it to the cost of goods sold or reduce the cost of goods sold with $30,000. That will be debit overhead, credit the cost of goods sold, and we reduce the cost of goods sold with $30,000. Second option that we have is to check what's the balances related to of 680 overhead, which we apply to the period. Where are those? Where is this amount in our work in process, finished goods, and cost of goods sold? So we find out that 68,000 of 680 sitting in work in process, 204,000 sitting in finished goods. The rest is cost of goods sold. Now the question is, how can I allocate $30,000 when I have this cost proportion? So what we're going to do, I'm going to copy this. I'm going to move to the Excel spreadsheet, and we're going to quickly do this. Let me grab it again because it doesn't let me copy it. Okay, for some reason doesn't let me, but there are always tricks that you can circumvent Microsoft. I'm gonna use the snipping tool, and that should save my problem. Just a second. That will be very quick. And that's my question. So what I have work in process. In work in process, let me make it bigger so you can see it. What I'm doing, I have in work in process account, I have 68,000 sitting there. I have in the finished goods account, 204,000. And I have in the cost of goods sold account, $408,000. Let's make this one bigger. And in total, I have, that's not the total, this is the total, $680,000. Now the question is, I need to reduce this amount proportionally. I already know. I need to reduce it with total of $30,000. Has to go less. Each of those accounts. So when I combine the total, I have to get a reduction of $30,000. Negative 30,000. And then calculate what's the total. Logical way will be to use the proportional method. What's the proportional method? I know the total is always, if I have to express the total as a percentage, will be total divided by total, which is going to magically give me 1. 1 as a percentage is always going to be 100%. Then I'm going to start expressing everything else. First one, I'm going to express work in process as a percentage of the total. is going to be most likely 10%. Then I'm going to express the finished goods as a percentage of the total, and that's going to give me 30%. Well, I already have 40. Total has to be 100. Most likely, the other one will be 60%. I don't even have to calculate it. I really know it's 60%. So I have get my totals for my percentage. Now what I have to do, I have to apply the 30,000 to each of those percentages. So the first account is going to reduce with 10% times 30,000. And I'm going to fix this cell. 3,000 deduction here, 9,000 deduction here, and 18,000 deduction here. And once I run the new calculation, my total should be reduced with $30,000, or my total should be equal to the original total minus a plus in this case of $30,000. So now I have to magically come up with these numbers for each of those. That will be 68 plus 3,000. And once I get everything, I come up with the $650,000. And that's how we are allocating on using the proportional method. Every time when you have to allocate something, use the proportional method, please. That's the safest way to do it. Let's go and finish our slides. So what they're going to do, they're not going to do anything different. They're going to come up with the percentage. We're going to see how much we have to allocate. And we put that allocation. Basically, we're going to debit manufacturer overhead, and we're going to start reducing work in process with 3,000, finished goods with 9,000, and cost of goods sold with 18,000, and we're done. Let's see this question. What do you think about this question? This company has actual manufacturer overhead of $1,210,000 and predetermined manufacturer overhead $4 per machine hours. The company worked 290,000 machine hours during the period. What's the manufacturing overhead? So what we need, we have the actual. What we need to calculate, how much was applied. What are you getting as applied? That will be 4 times 229 with 3 zeros. B, under applied to. Any other confirmation on that B? Yes, we have confirmation on B. Let's see if that's the case. Yes, it is B. Once we get the actual, the applied 160, so the actual 1,210,000, the applied is 1,160,000. We under applying $50,000. Again, if the manufacturing overhead is under applied, we have to increase cost of goods sold or increase all the 3 accounts. If the manufacturing overhead is over applied, we have to decrease cost of goods sold or all the 3 accounts. Now, this is a tricky question. I want you to think about a little bit and tell me, what do you think? What effect will have adjustment in the cost of goods sold for the over-applied overhead on here called net operating income? What do you think? Do you want me to do this in Excel? Okay, let's do it together. Before we do it in Excel, let me grab something and stop sharing my screen and share my Excel screen, which will be here. So what the question asks us, what effect will have adjustment in cost of goods sold? What we have to do, we have to adjust cost of goods sold. Let's pretend that this is the cost of goods sold now. We have to adjust this. This is our problem. And what will be the effect on the operating income or here on the operating income? For over applied overhead on the, so what we have to do in this case is under apply. What we have to do, we have to over apply it. Let's go with over apply. If we over apply, the actual is going to be higher or lower. Over apply is going to be lower. Let's put here 80,000. 80,000. So currently my cost of goods sold is 100,000. If I have to adjust it, what do I have to do? Increase with 20 or decrease with 20? Decrease. So if I decrease my cost of goods sold from 100 down to it, that will be balanced here 20. To balance it, 20. Sorry, I'm going to get this cell first, and then I'm going to plug the number. If I decrease it here with 20,000, what will be the effect on my operating income? Going up or going down? This is my original. This is what's happened when I make adjustment. What happened with the operating income? Going up or going down? Increase. Make sense? Why is increasing? Why? Because my cost of goods sold is over applied. My actual cost for the period is only $80,000, but I already put $100,000 as a cost of goods sold. Cost of goods sold reducing my revenue. So right now my revenue is over reduced with additional $20,000, which I don't have it as a cost. So if I have to make a correction to actually to apply the actual cost, not the one that I'm applying, my actual cost of goods sold is only 80,000. So currently, based on the over applied cost of goods sold, 100,000, show that my operating income is 5,000, but my actual cost of goods sold is only 80,000. So that means my operating income is going to go up with 25,000, 20,000. Make sense? Everybody comfortable with this? Okay. So yes, operating income is going to increase. Now we know why we're going to increase. So let's see the summary for the overhead. What we have to do in the beginning of the period, before the period starts, we have to come up with the predetermined overhead rate. How are we going to come up? We're going to get the estimated total manufacturing overhead cost. We're going to divide it by the estimated usage of the allocation base, and we're going to come up with the predetermined overhead rate. Now, that predetermined overhead rate during the period, every time when we're actually using the allocation base, we're going to apply to the manufacturing overhead cost. At the end of the period, we're going to compare the actual with the applied. If we over applied, we gotta check, is it under applied or over applied? Is it under applied? Then we have to allocate cost of goods sold. If we under applied, again, we have to allocate cost of goods sold or all those three accounts, work in process, finished goods, inventory. The other cost flow model will be raw material. Direct material is going to come from the raw material. Raw material is going to go direct material for the work in process. Indirect material is going to go to manufacturing overhead. Direct labor is going to come from the salary wages payable. Indirect labor is going to come from the same account, but it's going to go to manufacturing overhead. Now, from the manufacturing overhead account, we're going to get the manufacturing overhead, which is going to meet with direct material, direct labor in the work in process account. Once we say the product is complete, we're going to move that product from the work in process into the finished goods. And it's going to stay in the finished goods until we sell the product. Once we sell the product, it's going to become cost of goods sold. At the end of the period, we have to check manufacturing overhead. Is it under applied? Is it over applied? How are we going to deal with the multiple overheads? Obviously, this is the one that we explain, and explaining here is very simple because we have only one manufacturer overhead rate. What if we have more than one? Well, usually, most likely a large company, we're going to have multiple predetermined overhead rates. That will be more complex. On the technology system and the language that we're going to use, obviously, we tend to move to the electronic data, which is easily convertible to Excel spreadsheet and to convert it to numbers, which numbers we can use it to our calculation. And that's your chapter 5, people. So the sales mix comes from the idea that we are selling 2 or 3 different products with a certain proportion. What will be the proportion? Proportion will be based on the units sold or based on the sales. Different products obviously have a different selling price, different cost structure, different contribution margin. So for this company, let's assume the following information. I'm going to grab this information and again, I'm going to move it to Excel spreadsheet. So we can make it a little bit more interesting. And this is our calculation here. So we have our sales. I'm going to transpose this information quickly. We have our sales. We have variable expenses, so variable cost. We have a contribution margin. We have the fixed cost, which is common for the entire company. And we're going to come up with the sales mix here, what the sales mix is. First thing first, let's separate the sales variable cost contribution margin and net operating income. No, actually, I don't need that one. Second one can disappear. I need it once you get to fixed cost, I need the operating income. I have the elements. Now what I have to do is to get the bicycles, product 1. Product 1, and then we're going to have a product 2.
Excuse me, Ivan, would you share your screen, please?
Yes, please. Yes, I forgot. Lately, I'm very selfish. I don't know. The other course, the other day, they also say, hey, sorry, can you please share your screen? And I don't know. I feel like lately I'm a little bit more selfish. I really apologize for that. It's not on purpose. I was thinking to share it and I usually don't. So we have the two products. The next thing that we need to see is what the number says. We're going to plug the numbers and come up with the ratios. Sales price for the first product is 250,000. Variable 150,000. Then we have a contribution margin, which is 250,000 minus the 150,000. That's going to give us $100,000. Luckily, you haven't missed anything because at this point, I'm just transposing the information. That's 100%. And then we start expressing everything. Contribution margin divided by 250, that will be 40%. And this will be equal to 150 divided by 250. That's a 60% here for the variable cost. Now for the product 2, what we're going to have 300,000 here. 135.23. And then we're going to get the calculation. Should be like this. Convert it with the decimals. That's what we have here. And the percentages are like this. So now the total, when we combine the total, that's where it becomes interesting. If we have to see the total cost, sorry, that would be total. Right here, we're going to have the total sales, which are 250. This one's going to be equal to 250 plus 300,000. And we're going to have all those totals. Once we get the totals, now we're going to calculate the new ratios. As you can see now, when we have this product mix between those two products, our contribution margin, total contribution margin, is different, but based on the total level. Now we can add the fixed costs, which are fixed costs are common cost for the entire company, which is 170,000. And then we can get the operating income, which is the contribution, total contribution margin minus the fixed cost. Now we have all the numbers. Now, once we have the sales mix like this, what we have to do is we have to calculate what's the sales mix as a percentage. So what I know is this is my total, right? My total is 100%. And my total comes from those two products, product 1 and product 2, nothing else. So what they have to calculate, how much the product 1 contributes and how much product 2 contributes to the total. What's the contribution as a percentage? So the product 1, I can see that 250 divided by 550 is going to give me 45%. And the second product obviously is going to give me 55%, but just to make sure, I'm going to easily calculate it. It's 55%. 45 plus 55 give me 100%. That's my sales structure of this company. Product 1 contributes 45% to the total, product 2 55% to the total. Now at this point, since I have my contribution margin based on the total, I can easily come up with the break even as a total sales for the company. And that will be equal to break even of the total sales going to be equal to my fixed cost divided by contribution margin ratio, since I'm on the total sales. So the break even in total sales, then it will be equal to 170,000 divided by 48%. Or the break even in total sales, in this case, will be this one divided by 48. That will be my total the total sales that I need to achieve to get the break even. So my total of the sales has to be this much. If my total sales are that one, then I'm gonna be a break even. Why? Because if I run now the new calculation, let's run the proof and see how it's gonna be. Again, I'm chasing the total sales. If my total sales are equal to this amount, then my variable cost should be equal to this amount times 52%. Then my contribution margin is going to be 6. Is that going to be? No, that's not what the contribution margin is. My contribution margin in this case will be sales minus the variable cost. It's going to be 170, and I'm on the break even. So now the question is, since I have this, and I know the percentages here, my total sales are 352,830. But I already know that 45% of these sales have to come from the product one, and 55 has to come from product two. So my total sales from product one has to be total sales times 45%. Or 45% have to come from this product. And the other 55 has to come from the second product. Okay, I have the products. Now I have to come up with, if this is the total sales for my first product, and I already know that 60% is the variable cost. I have to get, that's my total sales time. The 60% is going to give me the variable cost. And this is the contribution margin that I have to achieve from the first product. And the second product is going to be, again, has to be equal to my total sales, but from 45% is going to be my variable cost, 55 is going to be contribution, and then that's how I'm going to achieve the contribution margin of $170,000, which will be equal to the operating income. Make sense? Do you guys understand the idea? So this calculation is important for me, and this percentage is important for me. Now, those percentages, I have to achieve it when I come to the break-even point. But for the break-even point, I'm using the information for the total. After that, I'm using those numbers based on the total here and based on the percentages which I calculated and for the sales for the two products. So product ones have to give me 45% of the sales, and product two has to give me 55% of the sales. So my total sales is going to be 100%. And then applying those percentages for the sales, then I'm going back to the original data. And I'm matching that original data here on the unit level, on the product level to come up with the calculation, which will be guarantee me that my contribution margin is going to equal to the fixed cost, which is going to bring me to the break-even point on the operating income. I believe you have one of those questions on your assignment for the cost volume profit analysis. Okay, let's stop this one and move to the trying to find out chapter 5. That's not chapter 5. I'm chasing chapter here, this chapter. Let me find it here on my screen. Where exactly is? I got it right here. So again, we come up with the break even as a dollar amount based on the calculation for the total contribution margin based on the total. Applying that percentage, now they're going with a little bit more precise of the percentage or the rounding on the percentage. That's why you're going to have this rounding error. In our case, I didn't use any rounding. That's why we are perfect. And once you come up with the sale total percentage of the sales mix, you're getting the how much you have to generate of those sales to come up with those products, having in mind that the first product contribute 45% to the sales, second product will contribute 55%. And assumptions for the cost volume analysis is that the selling price never change, variable cost per unit never change, and the variable cost behave as a variable cost in terms per unit stays the same, in total goes up. Fixed cost, same idea, in total stays the same, but per unit goes down. If we have the multiple products, sales mix is constant, or in this case, always going to be 45 for product one and 55 for product two. And if we're running manufacturing company, what will be that? That the whatever we produce, we're selling it. So units that we're producing, we're always selling. We're not building inventory. We're not using the inventory. Nothing like that. The last thing that I want to show you for the sales mix is this. And I want you to be comfortable with this because some of the questions, they might use this one. They can tell you that if you have two products, I'm purposely getting this total. If you have the two products, the sales mix is 2 to 3. Now, as you can see here, you don't have the percentage. Now, the question is how you're going to come up with the percentage. Any ideas? I'm chasing here percentage. 60 to 40. Okay. So basically what we're doing is, yes, you're right. We have the total. We get the total. That's why I left the column for the total, so that can guide you. You get the total, which total is 2 plus 3, and then go with the percentage. So what that means? That means 2 divided by 5 is going to be 1%, and 3 divided by 5 is good, the second percentage. Now, how this is going to change if we have 3 products? Well, it's never going to change, right? It's all about the presentation. I cannot 5 products here. It's always going to be the same. Why I'm telling you this because this one is very common for so many things in accounting. The proportion between you can even go later. I remember here on 1210 usually comes on the partnership when the partner sharing income 2 to 5 to 7, and then you have to come up with the percentages. You can use this calculation for everything. Don't forget 2 plus 3 is get the total. From the total express the proportion and you're done. That was the last thing that I wanted to show you. And that will be all.